I'm Matt Garrett, founder and CEO of TGG Accounting, and today we're going to talk about the important topic of cash flow. Often I'm asked, what are important things to remember to have good cash flow management inside of a company? There are two real things. First of all is you got to watch cash. Duh. The old saying, cash is king, right? But the thing people don't add on to that I think is very important is cash is king, but profits generate cash. Say that again, cash is king, but profits generate cash. So good cash management starts with good profit management. Oftentimes people are not watching their margins close enough, thinking they just need to get over that hurdle, then they'll be fine. If I just get that bank loan, if I just get that partner to bring in money, no, focus on profits first. Good cash flow management starts with good profit management. Now, if you are in a cash crunch, the second thing that you really need to consider is something called the 13-week cash flow forecast. A 13-week cash flow forecast is something that looks at every single week over the next 13 weeks. Why 13 weeks? Because that's a quarter. 13 weeks, where is your cash going? Where do you expect to collect it? And what cash is going out of your business? It's called a direct method cash flow statement because it's directly who's going to pay you and directly who you're going to pay on a weekly basis. And that will make sure you do not run out of cash, either paying too much in your bills or not collecting it. Here's another issue. How do you solve cash flow problems from financing? Well, sometimes financing can actually be a bad thing. So let's go through all the different types of financing, look at it and see what's good financing, what's bad financing. When you're thinking about cash flow and using financing to improve cash flow, there are two things you need to consider. What is the term of your cash flow need? So if you're buying something like a new piece of equipment that has a 10-year life, you should use a 10-year loan. If you're buying a piece of real estate that's got a 30-year life, you use a 30-year or 25-year loan. If, however, you're waiting to collect from customers and it's going to be 60 days until you collect, you use a line of credit. And that line of credit then revolves back around, you pay it off, and then you do it again for another 60 days, and so forth and so forth. So there are different types of financings to fit a need. Make sure your financing is aligned with the time you need the financing and the type of financing you're getting. The other thing, however, to think about is bad types of financing, things to stay away from. So, first and foremost, don't do financing with your customers. What does that mean? What that means is don't pay your customers to pay you early. If you give your customers a 2% discount for paying you early, you are losing profit. It's much better if they pay you later and pay you in full than you taking a 2% discount and getting paid early. Second thing you need to think about is accepting credit cards. If you accept credit cards and you have a merchant processing fee of 1%, 2%, 3%, and that's not reflected in your price, you're not increasing your price to account for that, you are losing 1%, 2%, 3%. And if you're a $10 million a year business, you could be losing as much as $300,000 a year in profit, which equates to cash, by taking other people's financing, like a credit card, accepting credit cards. The third thing you want to stay away from at all costs is something called factoring. Factoring is when you sell your receivables, you sell what people owe you to a third party and then they collect on them. And instead of giving you 100 cents on every dollar, they give you 90 cents on the dollar. Now you're losing 10 cents on every dollar, and chances are you lost almost all of your profitability. I jokingly refer to factoring as eating your feet. You might not be hungry, but you can't walk anymore. And if your business isn't profitable, ultimately the cash flow won't be there. So first and foremost, cash is king, but profits generate cash. Then align your financing properly, and then make sure there are certain types of financing that you're avoiding at all costs. Key drivers for cash in a business. There are two metrics that you want to track to drive cash in a business. One is called DSO and one is called DPO. Now don't tune out. Just because they're technical words, let's explain them. DSO is Day Sales Outstanding. It's very simple. Don't think about anything other than it's how long people are taking to pay you. Every single month, you should track how long it's taking for people to pay you, and you should know exactly what that number is. If you have $1 million in accounts receivable and people are paying you in 60 days and you think they should be paying you in 30 days, you would have an extra $1 million of cash in your bank account every single month if that's what happens. Think about that. Simply changing the number of days that you collect, in some cases, even just taking it from, let's say it was 30 days and you had $1 million in accounts receivable and you can take it to 27 days. Doesn't seem like that big of a deal, does it? It's an extra $100,000 of cash in your pocket. And you can either use that to pay down a loan, which saves you $5,000 in interest every year, or go use it and put it in a money market account or a CD or some other investment and get $5,000 a year in profit. So that $100,000, those 3 days that you're missing, are costing you $5,000 in profit either way. So when you're thinking about managing cash flow, you have to think about how long it's taking for people to pay you. That's DSO. The other side of that coin is how long is it taking for you to pay people, to pay your vendors, to pay your suppliers. That's called DPO, days payables outstanding. Again, same kind of thing. A lot of people feel like it's really good. I'm really good. I pay everybody very fast. Well, if you pay everyone in 10 days, but your contracts allow you to pay in 30, and you have $500,000 of receivables every month, and you're paying in 10 rather than 30, you're missing out on $1 million of extra cash you could have in your pocket just by following the contracts and paying in 30. What does that mean? If you had $1 million extra, what would you do with it? Could you go pay down some loans? Again, 5% make you an extra $50,000 a year. Could you take it and invest it, earn 5%, make an extra $50,000 a year? Either way, the keys to look at is how long is it taking for you to get paid and how long are you taking to pay people? Those two things combined can help you get good cash flow management.